Trump's tariff turnaround leads to a wild week for stocks. Joining us today is Mike Mussio of FBB Capital Partners. Mike, we started the week with a sell-off. We've had relief rallies now as Trump threatened tariffs on EU nations over Greenland. Then he pulled back on those. Are we in an era now where the markets are moving more on Trump's rhetoric and policies than they are on corporate fundamentals?
In the short term, we would agree that that is definitely the case. We had a from Liberation Day, last April, we had obviously sharp volatility, sharp downdraft in markets. We had backing off of that, kind of came around full circle, and markets had kind of a steady, relatively low volatility march higher through the end of the year. This week is has been more volatility. We had a holiday on Monday, sharp sell-off on Tuesday. Volatility spiked by almost a third from Friday's close to the close on Tuesday. And then we backed off of that as a country in terms of Greenland and tariffs. And we're basically, I think the Dow is a little bit higher than it was at Friday's close. NASDAQ and S&P are both within 10 points. So yes, I think in the near term, that's likely the case. We do think the stuff that supported the kind of long-term lower volatility for the balance of 2025, which was 9 months of recovery, was more based on economic fundamentals, both in terms of the economy and the corporate earnings of companies that make up the market.
But still, we just finished year one of Trump's presidency, three more ahead. Do you, however, anticipate more volatility? And if you do, how are you preparing your clients for that?
Yeah, so we think the event-driven volatility is very likely to continue. I mean, when that will occur is anybody's guess. To what degree? Again, remember Liberation Day, the volatility index, the VIX, was trading in the mid to high teens, spiked up intraday to like 60 over the course of 3 or 4 trading days, and then fell back down and has been in like the 15 to 17 range pretty much ever since. The level of volatility kind of matters based on what's going on, I think. In the first 2 years of the Biden administration, the overall level of volatility was actually higher than it has been over the course of the 9 months since Liberation Day. But remember what was happening. We were just rolling out vaccines through COVID in 2021. 2022, we had inflation hitting 9%, and the economy was struggling. The markets were down, 20% plus. So we don't really want to go back to that, but I'll give a couple points of volatility for a little bit of a smoother ride overall, and we don't have to feel like we're dropping off of a roller coaster 3 or 4 times a year. Clients don't love that.
Amid all this market volatility, we did get some solid economic data today. We got the third quarter revised GDP number that was at 4.4%, higher than expected. But the economy is being propped up by higher income consumers out there, and they are higher income largely because of stock market gains. Do you think that this bull market is necessary for powering this economy ahead?
Yeah, this is a chicken and the egg argument a little bit, but we do believe that, from an economic theory, the wealth effect is real. And so those who own stocks are invested in a market basket of assets with their net worth. They feel wealthier today than they did a year ago, and they did in the third quarter and likely in the fourth quarter as well, and that led to more spending on that end. But this does play into that K-shaped economy argument in terms of those that are very wealthy are spending more dollars, and that's pushing overall personal consumption, for example, up. But when you look beneath the hood and talk to like an average person on the street closer to average income levels, they're feeling quite squeezed. And I think that's where there's a disconnect right now between sentiment. You go out and you ask 1,000 consumers, how do you feel about the economy? You're not going to get great responses, but then, what are they doing? Well, some portion of those consumers, probably the top quartile, are spending enough to have growth rates and overall consumer spending that looks, pretty good. But how long does that dichotomy last is kind of hard to know.
A lot of the economic data that we've had was delayed because of the government shutdown, and you and I are talking about third quarter GDP right now. I guess my question to you is, do these figures matter at this point?
You can definitely make the case. I mean, we're talking about August and September data at the end of January. And what we should be getting this week, if you look back the last few years, is the first read on the fourth quarter, which is the more real-time data. And that's the data that should be congruent with the earnings numbers that we're starting to get from businesses. But there is a disconnect. We're getting third quarter data on the economy. We're getting fourth quarter reads from companies. And this stuff isn't going to sync up, Lisa, until April, if you look at what the Bureau of Economic Statistics says in terms of looking back at the first quarter. So these are kind of unintended consequences that are, again, underneath the surface from, a 6 or 7 week government shutdown, where we're still talking about consumer spending in November. We're still talking about GDP growth in the third quarter of last year. And so I think this is going to be very interesting to see next week leading into the Federal Reserve meeting, and where all of the large companies in the S&P start giving us, more real-time data.